Okay, good morning, ladies and gentlemen. My name is Michael O'Leary. I'm the Group CEO of RyanAir. I'm joined this morning by Neil Sorahan, the Group CFO. And we're pleased this morning to announce a report, strong half-year results, where profits after tax have risen to €2.18 billion due to a very strong Easter, record summer traffic. And we think, based on forward bookings into Q3, that we're on track to hit our medium-term target of a €10 per passenger profit. And the good news for shareholders is that we've also this morning announced our intention to declare our 400 million ordinary dividend payable in 2024. Highlights of the half year have been traffic has grown 11% to 105 million passengers. Average fares, as a result of very strong travel demand across Europe this summer, were up 24%. Ancillary revenues up 3%. We opened 3 new bases and 194 new routes in summer 2023. We've seen the game changer fleet rise to 124 aircraft. The total fleet at the half year end stands at 563 aircraft. Our fuel bill jumped quite significantly. It's up over 600 million to about 2.8 billion euros. But the higher airfares have helped us to pay off these higher oil prices. Fuel hedging has been extended, and I think we're in a very strong position. We're essentially 85% hedged for the rest of this fiscal year to March 2024 at around $89 a barrel. And the good news this morning is that we've now hedged just over 50% of our FY24 fuel requirements at about $79 a barrel, which means we've banked a saving of almost $300 million on the hedging of half of our fuel that we need for next year. Overall, during the half year, we've repaid about €1 billion in debt, both the second bond and some of our revolving credit facility. The big, I think, structural news in the half year is the 300 Boeing MAX 10 order that underpins, I think, controlled and what I hope will be profitable growth to 300 million passengers by FY 2034. And as I've just said, we've announced this morning a 400 million maiden dividend and also a dividend policy for shareholders going forward. Just to touch on the growth this winter, we'll operate 6 new bases at bases opening in Athens, in Belfast, Copenhagen, Girona, Lanzarote and Tenerife. We'll also operate about 60 new routes, including our first 17 routes to Albania, which I visited for the first time just 2 weeks ago. To date, over 90% of our summer 2024 capacity is already on sale. Forward bookings are strong, although at low levels yet, and this includes over 180 new routes in summer 2024. While Boeing are currently suffering delivery delays at Spirit, at this day we're working with them to try to expedite those deliveries, but we're concerned that up to about 10 of the 57 aircraft we're due to contract to receive before the peak summer 2024 may be delayed into the winter of 2024. It's a moving target, and we'll keep shareholders advised. I think the big trend, though, through next summer, as it has been last year, will continue to be the consolidation story in Europe and the capacity constraint. Eurocontrol have already confirmed that Europe short haul is operating about 94% of its pre-COVID levels in summer of 2024. We don't expect that to improve much next year. The consolidation continues to play its way out. Lufthansa is engaged in the takeover of ITA. TAP has been put up for sale by the Portuguese government, and it looks like AirFrance may take a 20% stake in the refinancing of SAS. We welcome this consolidation. We think the European industry needs to consolidate so that we get rid of these flaky, perennial loss makers like Alitalia, TAP and SAS. I think also a big factor in next summer will be the Prett and Whitney engine issue. There's an extensive inspection program that will really affect the A320 fleet, and we believe a number of our competitors are going to face very significant capacity challenges through the summer of 2024, which means intra-EU capacity will be constrained for longer than we had expected, I think, through 2024, 2025 and 2026, particularly given the large backlog of OEM aircraft deliveries. It continues to constrain capacity as well. Capital allocations, just want to touch briefly on it. As the business has recovered from COVID, the board has been committed to firstly restoring the pay cuts that was agreed with our people during COVID. We've also now put in place multi-year pay increases with almost all of our pilots and cabin crews across Europe. We've delivered on that. Secondly, we were determined to pay down debt as quickly as we could, particularly as interest rates are rising fast. We've halved our overall bond debt over the last 2 years, and we expect to take that down to zero by 2026. In addition to that, I think we've been focused on capital allocations that would, or aircraft orders. I think the 300 aircraft MAX, or the 300 MAX aircraft order, which we announced, which was been approved by shareholders at the September AGM, is critical to that now. It does leave us with a huge funding challenge for the next number of years, but the strong cash flow, the strong return to profitability, we think will enable us to pay for most of those aircraft deliveries without having to return to debt. I therefore think it's appropriate and opportune that the board has now decided to return or reward those shareholders who stood by us during COVID. RyanAir shareholders invested 400 million by way of a share placing during the peak of the COVID crisis. That enabled us to go out and borrow, raise another 850 million bond, and it was that cash that enabled us to trade through COVID and emerge out of COVID in a much stronger position than any other airline in Europe. Now that we can see, I think over the medium term, it's appropriate that, and we're pleased to declare a maiden ordinary dividend of 400 million, returning to shareholders the funds they invested in us during COVID. That's about 35 cents a share. It will be paid in an interim and final dividend of about 200 million each, payable in February 2024 and after the AGM in September 2024, respectively. The board is also believes now is an opportune time to declare an ordinary dividend policy. And going forward, for all years from FY25 onwards, the board is committed to returning about 25% of prior year profit after tax by way of ordinary dividends to the shareholders. And we want to thank those shareholders for their support during the very difficult COVID period. Turning to the outlook, we continue to target about 183.5 million passengers in FY24. I'm not sure whether we'll hit that number. It depends on Boeing meeting some of their delivery commitments between now and the year end. However, we will certainly get close. As previously guided, we expect ex-fuel unit cost to increase by about €2 per passenger this year, but that will still mean an ever-widening cost gap between RyanAir and our competitor airlines in Europe. Forward bookings into Q3 are robust, particularly for the late October midterms and into the peak Christmas travel period. And I believe with the benefit of constrained EU capacity this winter, Eurocontrol expects the capacity to recover to only 94% of pre-COVID this winter. The much more significant impact of the Prett and Whitney engine repairs on competitor fleets. We think we're set fair for strong growth next year, both in terms of headline traffic numbers subject to the Boeing deliveries, but also underlying airfares during the peak period of April and the summer period. Q4 is traditionally our weakest quarter. We have very limited visibility into Q4 this year. But I think on balance, we now believe we now expect that full year profit after tax will finish in a range of between 1.850 billion to 2.05 billion for the 12 months. That assumes modest losses over the second half of the year, the winter period. But this guidance obviously remains very dependent on the absence of any unforeseen adverse events, for example, such as Ukraine and the tragic events currently underway in the Israeli-Palestine conflict between now and the end of March 2024. And with that, Neil, I think we'll hand over to you to take us through the slide presentation.
Thank you, Michael, and good morning, everybody. RyanAir has the lowest fares and lowest costs of any airline in Europe. We're number one for traffic and will hopefully deliver 183.5 million passengers this year, which is a 9% increase on last year. We're number one for on-time performance and reliability. We rank number one for ESG by Sustainalytics in Europe. And our 300 MAX 10 order will underpin a decade of growth for RyanAir. Our financial strength and our lowest costs make us the long-term winner by a mile in our sector. In relation to coverage and choice, as you can see, 92 bases and 228 airports. We operated over 3,300 daily flights during the peak of the summer, and we believe that this unique network will enable us, coupled with the MAX 10 aircraft, to grow to 300 million passengers by FY24. Our unit cost advantage over everybody else continues to improve. The gap is widening between ourselves and everybody else. We came into COVID with a wide gap. We come out with an even wider gap. And we expect that with the new aircraft deliveries to improve for years to come. So a significant cost advantage over all of our competitors in Europe. Looking at the first half of FY24, it was a strong quarter. We saw 11% increase in guests or passengers to just over 105 million at a 95% load factor, which is an improvement on last year. Revenue up 30%, just under 8.6 billion, thanks to record bookings over the peak summer, a strong Easter, and of course 24% increase in average fares. Operating costs were up 24%, a lot of that driven by a higher fuel bill. We saw a 29% increase in our fuel bill in the quarter. But the final result was that we delivered a 59% increase, just under 2.2 billion profit after tax in the first half of the year. We have an industry-leading balance sheet, BBB rated by both Fitch and S&P. We had very strong liquidity at the back end of the half, despite the fact that we had 1.6 billion capex in the first half of the year. We paid down significant debt, and you can see the end result is that we saw net debt improve from just over 560 million at the end of March to over 840 million at the end of H1. Just focusing a little bit more on our balance sheet, this will underpin our growth as we move forward. We've got a very manageable and modest debt profile for the next few years. In September 25, we have our 850 million maturing bond, and then the final bond matures in May 2026. Capex this year, it's the peak of the game changer order book, so we're looking at 2.8 billion capex, although there'll be a material step down next year to 1.3 billion. And then it'll be approximately FY30 before we get to the peak of the MAX 10 order book, where we'll be looking somewhere close to about 3 billion. The expectation, similar to this year, is that we will fund this from our internal cash resources. And of course, we'll have some NG disposals, which will also help when we get to the MAX 10 capex. Our balance sheet, as I said previously, very highly rated, BBB+. But 534 Boeing 737s are fully unencumbered, which gives us huge access and flexibility in what we do. We continue to have access to the bond market, sale and leaseback, bank, and every other form of financing. But at the moment, in a rising interest environment, we're paying down our debt out of our own cash resources. This is very helpful, particularly in a market where there's huge capacity constraints, particularly around engine issues with Prett and Whitney, where our competitors are now paying between 30 and 40% just to extend 10 or 11-year-old leases within their fleet. So we've got a huge competitive advantage thanks to our ability to pay down our debt out of our own cash resources. And we believe that this will be a further reason why the cost gap widens over the coming years. With that, I might ask Michael if you'd take current developments, please.
Thanks, Neil. So we're seeing robust Q3 demand. Traffic and fares are well ahead, but there is some higher fuel on the unhedged fuel. We're continue to make market share gains across most major EU markets, and we see that continuing. We believe a key story for the next 12-18 months is competitors are going to continue to suffer capacity constraints. Eurocontrol saying about 94% of Europe short-haul operating about 94% of pre-COVID this winter. I think one of the important things is we've banked a significant saving by extending 50% of our fuel is already hedged for FY25 at about $79 a barrel, well below the $89 at which we were hedged this year. The Boeing MAX aircraft, we expect 57 of them due pre-peak summer 2024. The contract says before the end of April. We think and we're hopeful that we'll get most, if not all of them, before the end of June. But there is some delivery delay risk. To the extent that we're short 5 or 10 aircraft through the peak summer months next year, it will be inconvenient and regrettable, particularly if there's capacity constraint in Europe and strong pricing. But it won't fundamentally alter the growth in either headline traffic or profitability, we believe. As Neil has said, the 300 MAX order facilitates a decade of low-cost profitable growth to 300 million passengers. And this has enabled the board to declare or propose a maiden ordinary dividend of 400 million, which repays our shareholders the money they invested into RyanAir very bravely during COVID. Touch on the Q3 demand, very strong demand for the October midterm, which is last week. and for Christmas travel. Fares are up on the prior year Q3 by a mid-teen percentage, but we are paying for some higher. Fuel is up year on year. We've opened 6 new bases, 62 new routes, including 17 to Albania, which started last week with high forward load factors. Our short-haul intra-Europe capacity remains constrained at 94% of pre-COVID. We think summer 24 EU capacity will also be constrained, which will be a combination of consolidation, OEM delivery delays, and this looming Prett and Whitney engine, which I think crisis among our competitors. And we already have 90% of our summer 24 schedule on sale into that market, and we're seeing strong forward bookings and strong pricing already. Here I've set out just where we think the capacity will be constrained. You have the Prett and Whitney issue. MRO slots are full and lease rates are soaring. The cost gap widens even further. The consolidation will continue to reduce capacity further. If Lufthansa buys ITA, they will pivot ITA to feed the hubs in Frankfurt and Munich. They won't be expanding ITA's operations to and from Italy. There is a large backlog of OEM deliveries and delays. Not just Boeing, Airbus as well are struggling to deliver on time. And that constrained EU capacity means I believe we will see a reasonably strong second half of this year, but much more important, strong growth into summer 2024, both at the headline traffic and in pricing. We've set out here just a summary of what are very strong market share gains across all major markets in Europe. And as we take delivery of whether it's 57 aircraft or it's 47 aircraft next summer 2024, we will be one of the few airlines in Europe with significant capacity growth at a time when most of the other airlines who are taking deliveries of capacity are allocating those capacity to markets in the Middle East or where they don't have to compete with RyanAir. Touch just a summary of the hedge position. Here we are, as I said, this year, almost 85% hedged at about $89 a barrel. Next year already we're 52% hedged, but at about $79 a barrel. And that delivers or renders a saving of already banked a saving of about €300 million on the fuel bill for next year. The MAX 10 order will facilitate that decade of growth. The fleet, we believe, will grow to a minimum of 800 aircraft, and traffic will grow to 300 million passengers. And you can see next year, whether we get to 200 million or 205 million, I don't think it fundamentally alters. Boeing will resolve these delivery delays, and we will take the aircraft as and when we get them. Touch again on the capital allocation policy. The board has been very cautious and very conservative. We have a very strong balance sheet. We're now seeing very strong liquidity as we pay down debt, as we hedge. We're seeing very strong liquidity. At the period, we had for $4 billion in gross cash as we entered COVID-19. We had a strong investment grade rating, and we have repaid debt. The board is determined to continue to invest in growth. We're funding pay increases for all of our staff. That's now done. We're funding a very ambitious 737 CapEx program, done and continues to be done. And we're investing heavily in resilience, crew training, building simulators, building hangar training centres, acquiring more spare engines and parts, and we're looking at now building our own engine shop. And I think one of the key features of this summer has been dramatic improvements by RyanAir Labs in our customer app, our day of travel app, making it easier for customers to interact with us and us to interact with our customers as they travel with us. And all of this leads us to a new era, we think, of shareholder returns. So the board has set what I think is a conservative and cautious dividend policy. We're paying out a 400 million maiden dividend in 2024. That repays shareholders for the money that they bravely invested in us during COVID. And the board has gone further by setting out, I think, a reasonably conservative dividend payout ratio going forward from FY25 onwards. 25% of prior year PAT pre-exceptions will be paid out to shareholders by way of ordinary dividends. That doesn't preclude or exclude future special dividends or share buybacks, but only when we can see cash flows building or when we generate spare cash. We promise to continue to return that to our shareholders. We continue to be best in class in ESG. As Neil has said, rated number 1 airline in Europe by Sustainalytics, BBB rated by MSCI, and B rated by the Carbon Disclosure Project, and we hope to see that B rating rise to an A rating when they re-rate the industry sometime early in 2024. In terms of outlook, full year traffic, we're still sticking to that target of 183.5 million, up 9%. It is, however, subject to Boeing delivery delays. It might move maybe 500,000 passengers, but fundamentally I think we'll get to 83 million plus. We're seeing strong, robust demand in Q3 at higher fares, although we do have higher fuel. Competitor capacity constraints, I think, will be the story of this winter 2023 and also summer 2024, which I think sets a reasonable prospect as we expand into new markets with up to 57 new aircraft. I think you'll see strong traffic growth, and I would hope a third summer of strong fare growth. We'll still have low fares, but you're not going to see any $9.99 seat sales. FY24, we expect profit after tax now to be in a range of between 1.85 billion to about 2.05 billion, back to somewhere just above 10 euros profit after tax per passenger. We are a very profitable airline, but it's a very modest profit at 10 euros per passenger, given the resources and the capital that we've invested in this business. So we hope to continue to trade at around 10 euros profit per passenger in the coming years. The board has declared a conservative dividend policy that adds to shareholder returns, which have been very significant over the last decade. We continue to manage a very strong balance sheet, BBB plus rated, and we continue to execute fleet and market share gains. And I am absolutely convinced that our timely MAX 10 order with Boeing will facilitate our growth to at least 300 million passengers by FY 2034. And with that, we're going to open up to Q&A.